at all. As the bottom left-hand chart indicates, non-U.S. world corn production went through the roof from about 2006 to 2014 as the prices ramped up. Not only did the price encourage more production, but also when all the seed genetics firms changed their research from seed that was industry specific for, say, the poultry industry or pork industry to let's grow more corn and more drought-resistant varieties, it made a huge difference. And as all of us know who were on the Black Sea cruise 3 or 4 years ago, that encouraged the production in the Ukraine. And without $8 corn, that would have never happened. Without the seed genetics, it would have never happened. And so the right chart shows the non-U.S. Competition we picked up on the export side. Again, Ukraine 7-8 years ago didn't exist as a competitor. Today, the Ukraine has about 16 to 18% of the world's corn export market share. Another game changer has been the change in the oil industry. Fracking in North Dakota and to a lesser extent elsewhere around the U.S. has changed the energy markets, and that will probably be a change that's going to last forever as well. Fourth change is a technology transfer, and specifically this would be the sale of Syngenta to ChemChina. If you can't buy the technology, buy the companies that make it. And long term, we see this as a depressant on grain prices because we're now going to see our technology marketed around the world, and we have created more competitors. The fifth one, and we believe strongly that this one is going to happen, the sale of Monsanto to Bayer. You know, all they're really negotiating right now, we believe, is they're going to have to spin off one of the 3 cotton seed companies, because between Delta Pine, which is owned by Monsanto, FiberMax, and Stoneville, which are owned by Bayer, those 3 companies have 75 to 80% of the market share. And so there's negotiations going on right now on spinning off one of those companies. It'll be a good buy for somebody. And of course, they're also negotiating the bailouts for all the top brass at Monsanto, which, as you might guess, they're going to come out quite well. The other thing that's happening, though, and I don't think this is good for Monsanto shareholders, if you look at value, it's a good value compared to where the market's been for the last 3 months. It's not a good value compared to where the Monsanto stock has been for the last 5 years. But nevertheless, this is what happens when the ag economy comes upside down, and we and acquisitions everywhere, and it's happened rapidly in the retail area in rural America as well. Some other changes, as all of us are aware, particularly those of you in California, water availability is a major issue. I'm not going to spend any time talking about it. It's pretty obvious. The other thing that is taking place, again, is the consumer demand shift. You know, we look at organic. You know, as many of you are involved in the production of organic milk. You know that it's a growing market. But the thing that we see happening even more is the non-GMO mood. The millennium generation likes the non-GMO. Now, you know, realistically, a lot of us will joke, I mean, how many years do you have to go back to find seed that's really non-GMO? I would suggest you probably have to go to BC to find non-GMO seed. But nevertheless, I mean, someone's drawn a line in the sand and say this is non-GMO. But this was taken to a local grocery store just 2 weeks ago, and you know, I'm sure it's a top-moving product where people can buy Similac now that's non-GMO. This is a sign that one of our clients took in front of a restaurant in one of the suburbs of Denver. Obviously, not one of the more conservative suburbs of Denver. This is, I mean, this literally happened. The sign in front of the restaurant says gluten-free, non-GMO, vegan, no preservatives, microbrewed, organic, fair trade, women-owned, socially responsible, and B Corporation. I'm sure Donald Trump probably didn't put that sign up, nor frequents this restaurant. But you know, and I think it's a very small percent of our population. that would be into something that restrictive. But nevertheless, I mean, this exists, and these are trends that I think all of us need to address. Some changes in the economy. I don't think there's any question that we can all recognize how the strong value of the dollar has impacted exports. If we roll back just 5 years ago, I always said, and most other ag economists said too, when you take a look at the exports of corn specifically, the value of the dollar did not impact our exports because we were the world's dominant player. Now we're not the world's dominant player in many commodities, and now all of a sudden then the value of the dollar has become very influential on our exports, dairy products as well, and grain. And as you can see in this chart, since 14, value of the dollar has been extremely strong. And we actually believe this is going to continue, particularly against the euro currencies, as that economy over there is doing very poorly. We look at the red line, which is the CRB, Commodity Research Bureau Index, which includes all agricultural commodities, energies, and precious metals. And the blue line is the U.S. dollar index. You know, starting in mid to late 2014, as the dollar started to strengthen, we can see it impacted the entire commodity mix price values in a very negative way. Also, and while it doesn't make a lot of sense, there's a strong correlation between crude oil prices and corn prices. There are a couple of years where the correlation blew apart, but primarily it was 2012, where you can see in the blue line corn prices rallied sharply while crude oil prices went sideways. Now we're in a situation where crude oil prices bottomed in January, up roughly 50% from where they were in January, and have bounced back, and the corn market has pretty well followed. So the trend this is in the same direction in both commodities. And again, while it doesn't make a whole lot of sense why, some can say because corn is energy related. Well, if you go back 15 years ago, it really was not, and yet we saw the correlations back then as well. I took this picture driving by a gas station in February. I'm sure those of you in California never saw a sign like this, but those of us who spent some time in Florida saw it. And local gas station gas was $1.39 a gallon for regular. Now, of course, their racket is if you pull in there and put in the super unleaded, though, it's 70 cents a gallon more. So they pull everybody in with the cheap price and sell them the higher price stuff. But nevertheless, $1.39 for gasoline, and a 20-ounce bottle of water was also $1.39. I just found it very ironic that you could buy the same thing for $1.39, which the water then equates to $8.90 a gallon, 6.4 times more expensive than gasoline. So it just shows how crazy some of us can be. Here's a monthly crude oil chart going back to 1998. And you can see what the market has really done is just rallied back to the old breakout point. Go on to the next chart. This is up to date through early this morning. You can see the bottom back in January at about $32 a barrel. We got up to almost $52 a barrel. If you look towards the left side of the chart, you'll see 51 to 52 is where this move started in November of 15. So if you look at it from a pure technical point of view, we think this market established a bottom in January. We think we established a top here just within the last week. This market is actually in the process of putting a weekly reversal down. We're down another 56, 60 cents a barrel here this morning. This is not a market I would want to be aggressively buying now. Back in January and February, those of you who are clients of ours know we were aggressively buying diesel fuel back then, but we really haven't made a big move in this market since February. Here's one of the reasons we're not at all confident the market is going to move much higher. Inventories are still extremely large. Where you can see where the line is for 2016, where we're in 15, and you can see the range between 11 and 15. So it's going to take some while to eat through this inventory. We're also back up to prices right now where fracking is economical back in many areas of the country, and so even though we have the inventories to eat through, I think we're going to see some increase in production. If you look at the monthly change in oil production, it pretty much follows the price. expanded rapidly in 2012 and 13, and really fell apart in 2015 and absolutely collapsed here in 2016. A few comments on the economy, farm economy. There are 7 stages of the agricultural economic cycle, and if we go back to the mid-1980s, some of you probably weren't around then. Many of us were. And 85, 86, and 87 weren't very fun years. We think stage 4 was about 2012. And one can argue that we are where our dot says we are now, between 5 and 6. If someone wanted to take the position we're between 6 and 7, I really wouldn't debate that. We're somewhere in that stage right now. But I think the important thing to recognize in the long-term ag economic cycle is that bottoms are long and flat. And the reason for that is pretty clear. In most cases, the supply side to the bull move to the upside is led by a shortage of supply. And when markets get cheap, grain farmers are thinking just about like dairy farmers are now. As we all know, in the milk industry, if prices are strong, you add cows. If prices are weak, you still add cows, because we look in terms of the monthly or weekly milk check. Right now, the majority of grain producers in the United States this past winter, 98% of the meetings they attended focused on how to increase production. So the market gets cheap. The emphasis is on how do we grow more of it so that we can make it cheaper. A friend of mine changed my chart here. I always said it was greed, hope, and fear, and he said no. This was a guy in the stock market. He said no, it's really greed, hope, and mad, because when things go the way investors, or in this case grain farmers, don't want it to go, they just want to look for someone to blame. They just want to get mad, and we saw a lot of mad people in January, February, and March in rural America. It was not a good time. Show you a little bit of a change of what's going on the farm financial side. This is from the Federal Reserve Bank of Kansas City, and the blue line shows the increase in carryover debt in the first quarter of this year. And I think we'll focus on Nebraska, which is a very key state, and you can see how much the carryover debt just accelerated in Nebraska. And what we're seeing throughout the country, in some states more than others, it has been tradition in the southern states, Mississippi, Louisiana, and Arkansas, for example, that a lot of producers have been carrying over their operating line from year to year, because they weren't making enough money to pay off that line. This year, creditors have taken a much stronger stance on that and said, look, we're not going to finance you if you keep rolling this over, and force a lot of producers to take equity out of their farmland. The mortgage companies in the land market, the federal land banks of the world, Metropolitan Life, a good example, they were busier than one-armed paper hangers this winter, writing new mortgages on land, a lot of which never had a mortgage on in the past. So we've seen a lot of increased debt in the last 18 months. This shows the debt to equity ratio, and you can see as we're not close to the problems we had in 1985. But I also think this is very misleading, because this is about 6-month-old data, maybe 8-month-old data, and it has changed a lot since this chart was made. We've had a lot of debt, and this is starting to show, chart is starting to show how the debt is increasing, and even more concerning is take a look what's happened to the non-real estate debt in just the last 2 years. So we've got a real heavy burden market right now. To give you a further example of what's going on right now, I think North Dakota is probably the worst situation when it comes to this financial crisis. At our own client seminar in February in New Orleans, we had farmers from 28 states. And upon introductions, one farmer pointed out, and he was from central North Dakota, said that 20 farms in his county did not receive refinancing this year, and 30 farms in the county next to him did not get renewed. So you were talking, on average, in many counties in North Dakota, 25 producers being put out of business this late winter, early spring. There was a lender from Farm Credit in the audience. I asked her if that is really true, and she said most definitely it is. The reason North Dakota got in so much trouble versus other states is because of fracking. Most of you can recall, if you go back 3 years ago when fracking was booming, North Dakota farmers couldn't get rail cars to rail the grain out because everything coming in was full of sand and everything going out was for oil. And so their bases widened by about $1.50 a bushel under normal, and a lot of producers chose not to sell the grain, and of course then ended up dumping it at even much lower prices. So absolutely devastating in that area of the country. This is also from Federal Land Bank of Kansas City. Just showing how the renewals and extensions of debt is just rising rapidly. You look at the bar graph, farm loan demand from where we were in early 14 to now has changed appreciably, and we don't see that this is really going to change a lot. Another thing interesting in the banks right now, later this month we do our annual, last week of June we do a series of seminars throughout the Midwest. And I'm looking at the registrations coming in right now, and it's almost all early registrations are almost all ag lenders that are coming to this meeting, and they're bringing along their key customers with them. They're making them come, and all of a sudden have to learn something about marketing. So it's a sign of the times. A lot of change is taking place. The good side for the grain guys is input costs are dropping. Nitrogen prices follow the price of corn. Corn's collapsed. Nitrogen's coming down now finally. Potash and all your other fertilizer prices, you can see by this chart, have also declined appreciably since the first of the year. So trend of what's happened in some of the Midwestern states on farmland values. Iowa's down 6.3%, Illinois 0.6%, Minnesota down 2.5%. The U.S. as a whole, though, is actually essentially unchanged at 0.7%. And what we're seeing there is the areas that did not have a good crop last year. That's where you're seeing the biggest declines in values. South Central Indiana, for example, a lot of the land didn't get planted last year. You're seeing some pretty good hits in cash rents and land values there. Some small areas in Illinois, but if you go into your major producing areas, Decatur, Champaign, Illinois, obviously California as well, we haven't seen much of a change in land values at all. Nationwide, though, here's what's happened, and this is all based on USDA data. The black line is the average value of U.S. farmland in the United States. You can see last year it was $4,130 an acre. The blue line is a land value based on a regression formula that we use based on income forecasts from the USDA. And I've shown this to you before. This is not the first time this group has seen this graph. We've been using it for probably 10 years. But if you go in the from 1986, 87 to about 2001, you can see the regression formula indicated farmland value was worth more than what it was trading for. And reasons are obvious for those of us who lived through the mid-80s. Either A, you didn't have enough money to be buying farmland, B, you couldn't borrow any more money, or C, you were just scared to buy anything after watching what happened in the mid-1980s. Now all of a sudden we have a reverse situation. We have an environment where the average value of farmland is 25% overvalued based upon the income that land is projecting. So one of two things is going to happen. Either farmland values are going to come down or incomes are going to come up. My opinion is we're going to see a little bit of both. We're going to continue to see some leveling off and a softening only slightly in the farmland values because there's still a lot of cash left to buy farmland. There's cash chasing everything right now. The other thing that's happening is incomes are going to be better, we believe, than what USDA is forecasting. You take a look at what's just happened in the last 6 weeks. Price of corn has shot up sharply. Soybeans, the same thing. This rally in the grains is allowing a lot of grain producers to bail themselves out, and we are seeing, as of today, a lot of corn and soybeans moving in the market, old crop and new crop being priced. The other thing is take a look at what's happened in the livestock sector. Look what's happened to the price of milk in the last 2 weeks. It's been a pretty incredible bounce to the upside. We take a look at a pork market where hog prices have gone into new contract highs in the last 2 weeks. So we've seen some very significant improvements, and so we think the spread again is going to narrow twofold. One, increased incomes and a little bit of a softer price. Here's the biggest concern, and this is not a forecast, but I think something that everyone should have in the back of their mind. We have always said you'll not see a collapse in land prices because we don't have the debt like we had in the 1980s. Back then we had very highly leveraged land. We had an 18% lending rate, so we had forced liquidation sales. And we always said, okay, that can't happen because there's not high debt. But the question then is, what if the debt-asset ratios increase and we have a regulatory forced decline in asset values? This is a concern. I know some of you know Dave Cole. He and I do a lot of the speaker circuit together. He and I were discussing this a year ago, in that, and we were at one of our meetings, and we're talking about what if the regulators were falling in, as Dave pointed out to me. He says, Rick, I don't know what you're asking. He says there are people from the Kansas City Reserve sitting here in this room, and he's right. I mean, I think and I look at the banks and lenders that are attending our seminars in 2 weeks. We got a lot of regulators coming to these meetings, and so I would just say that we've got regulators that are really concerned about this. And so here's an example. Let's say you go to say south of Lafayette, Indiana, where land prices dropped about 15–20% this year because they didn't get the crop planted. And let's say you had a farmer that was 40% leveraged going into this situation. Now all of a sudden he's borrowed more money in the last year because he didn't have a crop to sell, and his old debt didn't change. And now he's looking at a decline in asset values. So now all of a sudden you put his debt to asset ratio on a piece of paper, and he's gone from 50 to 75% leveraged. And what if a regulator comes into one of the banks in that community and said, you know, you got to get this guy in better shape. You can't be loaning him any money with a debt to asset ratio of 75%. That's what worries us. Again, don't take that as a prediction. I just think it's something we've got to be cognizant of as we go ahead, that if this grain market were to turn back south, or meat prices and dairy prices turn back south, and this leverage increases, then I think we've got to be really, really concerned about the regulatory impact on asset values. All right, let's go on to the corn market. All of you listening to this have seen this chart many times. We've been using it for 25 years. Very dominant cycle on corn prices. 1917 hit 221 a bushel, 31 years later 48 hit 284, and then 26 years and 22 years and 16 years, peaking in 2012 at 854. Peak to trough, first one was 15 years, then 14, then 13, then 9. I think the last time I spoke to this group was back in Boston almost 2 years ago this fall, and you know, even then I made the statement. I said, you know, they will probably shorten this cycle, peak to trough. So let's say it's going to be 6 years. So that means a bottom in 2018. Well, you know, maybe it's been shorter. Maybe we just saw it. I think we have seen the bottom. The bottom occurred in October of 14, that low 2 bars over. But I think it's probably going to be at least until 2018 before we have a major move up that would take us back to that $6 mark. I'll be more specific here in a minute. As we look at a balance sheet of corn, we've got the USDA's projections on there as well as our own. You know, we think we planted 91.5 million acres of corn this spring. I guess Informa came out yesterday, and they were at a little bit higher than we were, 92.6 or 7, I believe someone said. The USDA is at 93.6. Everybody in the industry is in the same camp. The USDA is too high because that was their March intentions report, and that number was put out there before we had all the rain in the south. And for example, we had a large number of clients in the Mississippi Delta, Louisiana, and Arkansas that when it got to their drop dead date on planting corn versus soybeans, which depending on exactly how far north you are, but ranges essentially between April 12th and April 14th. They didn't have the corn planted. They had to switch from corn to soybeans. So the number in corn is going to be less than what the USDA is forecasting, and beans is going to be higher. So most people in the camp here are close to 91.5. Yields obviously can be anything at this point. But if we use a trend line yield 169, then we're looking at a crop of 14.145. Usage numbers aren't going to change a whole lot. If you take a look at our estimate of feed and residual, we're at 5.5. USDA is also at 5.55. Last year was 5.3, so we're factoring in increased poultry and pork production into that number. The ethanol industry is a mature industry. We're forecasting a 5.3 as well as USDA, based primarily on exports, which I'll show you in a minute, which have been very, very strong. Exports are also improving, bumped up quite a bit here in just the last 2 months. So we're forecasting a 200 million bushel increase in exports this year. That still leaves us, though, with a carryover of 1887. The USDA is a little higher than that. But keep that number in mind. That's a 13.4% stocks to usage ratio, would equate to an expected average price of $3.25 to $3.75. So if we go on to the next slide, and again, this is one we've used many times. If you look at the top price curve, and you look at the horizontal axis, and you look at a stocks to usage ratio for 16, 17 to 13.4%. The reason we're coming up with the $3.25, $3.75 price, you go up to your curve, go over to the right-hand side, it would intersect about $3.60. So, take 25 cents above and below, and that's going to be pretty accurate. And as we've said many times, as long as you have a stocks to usage ratio 10% or higher, corn prices are pretty easy to forecast. When you get to less than 10%, price curve becomes vertical, and it becomes almost impossible to forecast. So, at this stage of the game, we're still pretty confident. We're looking at an average price of corn around that 365 to 375 area, and we were selling corn in central Illinois for new crop delivery today at $4 a bushel. So we've got a market right now that is overpriced relative to the fundamentals, unless the weather forecast changes and it doesn't rain any in the month of July and gets really hot. Here's a graphic representation of the carryover supplies. This is something I'm sure everyone is aware of. Just remember where it's important if a drought occurs. A lot more important to have a drought in Iowa, Illinois, or Nebraska than it is in Missouri. Missouri droughts impact Missouri farmers, but it doesn't really impact much of the other fundamentals in the price of corn. Here's our crop moisture index. Again, California, as always, has an issue, but if you look at the central part of the Midwest, there are no drought areas right now of any significance. It doesn't show in this graph, but there is a pocket in central Ohio that has some issues, and as John Noble said earlier, there's some issues probably in upstate New York, but we're talking, still not severe drought type conditions, and we're certainly early in the season here. And areas that were drought stricken last year down in Texas and getting up into Oklahoma, you can see actually have too much water, not too little. As we take a look at comparing the drought monitor index right now compared to where we were a year ago, even for those of you in California, you can see it's not as severe now as it was 1 year ago. And other than some isolated areas down in Tennessee and the Delta, we really don't have much of a crop problem right now. Take a look at the crop condition report. Again, we're near as high as we've ever been this time of year. Exports, as I said earlier, have been running very strong. We're going to exceed the USDA's forecast. Take a look at the world's ending stocks, pretty well flattened out. We'll take a look at changes in the world corn production. You take a look at China, for example, in 13-14, 218.5 million metric tons. That's where they're at right now, but down from where they were a year ago. They started eating into their stocks, and they dropped their price support system for corn back in March. Brazil's up slightly from where they were 3 years ago, a fair increase from a year ago. And so, and you take a look at the FSU 12, pretty much flat. Graphic representation of harvested acres and how we fare with China. They plant about the same number of acres we do. This is an interesting chart showing corn production in China and how it pretty much mirrors their corn consumption. As we all know from the Beijing trip that China wants to be self-sufficient in corn. They have no desire to be self-sufficient in oilseeds. But take a look what's happened to their stock buildup, and their stocks to usage ratio is 45%. The problem there is some quality issues, but nevertheless, some of those quality issues in corn, it can still be fed in livestock. Here's an industry that's changing quite a bit. We take a look at the mandated levels. Obviously, it's leveled off. We don't think that's going to change at all in an election year. As a politician, they need the electoral votes in the Midwest, and so they're not going to try and upset that group, and yet they don't want to upset the popular vote outside of the Midwest, which is anti-ethanol. Now, we're the only country in the world that is anti-ethanol, but it is what it is. Particularly corn usage for ethanol, very seasonal, ramps up rapidly as processors need more gasoline, more ethanol for the summer driving season, and then it starts to taper off. This is a really interesting chart. If you look at the bottom bars, it shows you the profitability of ethanol plants. You look in 2014, these plants were printing money, and there's 1 month there where the average plant was netting a profit of over $1 a gallon. Now we had some losses here in the first part of this year, but now we're getting back to profitable. But actually, most of the plants are doing better than this graph shows, because this does not include byproducts. You throw the income from byproducts on there, and most ethanol plants right now are making a pretty good profit. Look at the black line in this chart. It shows you that exports of ethanol are at the highest level they've been since December of 2011. Exports have been very strong, and the next graph is going to show you why. Look what's happened here. A year ago in the first quarter, China didn't buy hardly any of our ethanol. Now all of a sudden they're the biggest buyer of any country in the world. To be honest, I can't really explain what's going on here with the poor quality of corn they have and the large piles of corn that they have, and the fact that they have many ethanol plants of their own, why they aren't in the poor quality corn and using their own ethanol plants. But they have just done a complete reversal in the last 12 months, and where Brazil and Canada had always been our largest buyers, their purchases of ethanol now are pimping on an elephant's back compared to what China is doing. Now, this goes back to a year ago. In 2015, Canada accounted for 30% of our ethanol exports. As you can see, China was only 8%, Brazil 14%. Fast forward, now China's 32%, Canada's 17%, and Brazil's 16%. I think it's really interesting to see how many countries buy ethanol from us and in relatively quantities. And yet, you take a look at China's imports of DDGs, down 87% from the peak. So for whatever reason, they've quit buying our DDGs, but now they want to buy ethanol produced by our ethanol plants. But then take a look at the bottom graph. The exports of DDGs to the rest of the world is near an all-time high. This is just to show a little bit of difference of what's happened in farm incomes in the last 3 years. In a way, we're tooting our own horn here, but we've had three of the most unbelievable years we've ever had in the markets. Our average selling price, for example, for our corn producers was $5.71 in 13-14, compared to a national average of $4.46. 14-15, $4.68 versus national average of $3.70, and the highest the market ever traded was $4.15. Same thing happened in 15-16. Our selling price exceeds the market peak, and this year, if we closed out everything, we'd be at $3.82 3/4 for the 16-17 crop. And we're never going to be able to do that again because our hedge profits in 2013-14 were almost $1 a bushel. just slightly under $1 a bushel in 14.15 and 32 cents in 15.16. And right now, if we closed everything out, we'd be down 7 cents a bushel on hedging profits for this year. But since the market's rallied 70 cents, to lose 7 cents is we think we hit a home run there. On the longer-term chart of corn, this is up to date through this morning. You can see the monthly chart. You can see the market's just rallied back to where we were in 2013 or 14 when we broke out of this. Yeah, you can build an argument for corn rallying in that 450 to 470 range. If we look at a shorter chart here, I'll explain why. This is the July chart up to date through mid-morning. I don't have live quotes in front of me. I know the market's closed right now. I don't know exactly where we closed, but I'm sure we closed higher. If you look at a December corn chart, this is up to date through an hour and a half ago. This is still a strong looking chart, and if you look at the gap that was left last week at 420, without going through the math for you, if that's a measuring gap, it gives you an objective of 464 in December corn. I think there's probably a 50-50 chance you're going to get to that number. This does not look like a market to me that has peaked yet. And with that gap objective there, it's only another 20 cents away. We'll probably be there before the 4th of July. This is a market timing-wise. I would be anticipating a major top in it as around that 4th of July weekend. And right now, again, there's nothing that looks like a top, and we've got money chasing this market right now, and so I don't think they've quit. D17 corn, pretty much the same thing. A little bit about the protein market. We've had the soybean market nearby is up to about $12 a bushel. Things obvious about the soybeans is the cycles are much shorter. You can have a 2-year cycle in soybeans, all having to do with the fact that two major producing areas of the world. You look at a soybean carryover, we're at 366 million. Our forecasted planned acreage is 83.5. My understanding is Informa came in yesterday at 83.7. The USDA is at 82.2. They're low. Again, that's their March estimate, and they'll change that later this month. But based upon that, I don't even know why they bothered to put it in print of 260 million bushel carryover. No one in the industry believes that number. Almost everyone is somewhere in the 350 to 375 million bushel carryover. But note the stocks to usage ratio gives you about 9.3%. Should give you an average price of soybeans in Central Illinois under $10 a bushel. And we're $2 over that right now. So this is a market that, in our opinion, is very, very overpriced. This is a graphic representation of the carryovers. Here we are, soybean planting progress. Obviously, we're about done right now. The crop condition report yesterday reported was an all-time new high in the good to excellent. Way too early in the season for that to really mean anything, but nevertheless, it's off to an unbelievable start. A lot of states are important when it comes to soybean production. In corn, it's 5 or 6, but here we're talking maybe 15. Soybean export commitments are incredibly strong, again, almost all due to China. World ending stocks of soybeans are declining, but still very, very high. You take a look at how the production has changed. You see Brazil continues to ramp up soybean production from 86 to 103 million metric tons. We're up quite a bit from where we were in 13. Argentina is as well. So worldwide demand is increasing, production is increasing just about as fast. Soybean harvested area, Brazil will harvest more than we will this year, exceeding us, and China is pretty flat. Here's maybe one of the more important charts that I'm going to show you in this presentation. This is from the CFTC's Commitment of Traders report. Comes out every Friday afternoon. And what we're tracking here is the position of large speculators, which essentially is commodity funds and commercial companies, which would be the Cargills and ADMs of the world. So concentrate on the black line. If you go back 2 months ago, large specs had a net short position of about 140,000 contracts. They are now net long about 200,000 contracts. So what it tells you is that the buying of the last month and a half has come from speculative funds. That's where the buying has come from, because in that same time frame, commercial companies went from being flat the market to being short almost 300,000 contracts. What's also significant about this is if you roll back, the last time we were in this position was in 2012, right before the collapse. And to us, it's not a question of what's going to happen in the protein market, it's a question of when it's going to happen. Because whenever your buying has come from a market that is driven by a short supply, i.e. problems in South America, and that the buying has come from money from speculative funds, when this, and their trend followers, when this market turns, these funds will fall all over themselves trying to get out of this market, which is why a spike like this inevitably leads into a collapse. And we think we're getting actually very close to that right now. Same thing is true in soybean meal. As you can see, we're reaching all-time highs in the size of the speculative long positions these funds have. So this is a scary situation. I think, you know, if a person said, okay, where's the money, big money going to be made in commodities in the next 6 months, I think it's going to be on the short side of soybean meal and the soybeans. And I was saying it started today, but I'm telling you we're getting very close to it. Here's July beans up to date through earlier this morning. And, you know, I don't know exactly where we, I'm getting the prices now. Yeah, I see corn closed very strong today. July beans were essentially unchanged, up 1/2 cent. And so it really was kind of a nothing day there. Let's go into the next chart. November beans finished the day at 11.49. You can see they were 11.50 when we made this chart a couple hours ago. Yeah, it doesn't tell me anything definitive. It's a market trying to make a high. I will say that if you're a technical trader, the congestion area in May, if it were to be 50% up from the base made back in April, then the objective was $11.83. Yesterday's high was $11.86.5. So this is a market that, you know, if you're a technical trader, you're saying, okay, the objective has been made. It's time to be looking for a place to sell this market. And you know, as a result, you know, you could build an argument that today was the day to be selling soybeans. We have been following this market with tight sell stops. We're 30% hedged in it right now and looking for a place to go into that 60 to 80% range. You look at a continuous monthly chart of meal, also something very revealing. The blue line at the bottom is an oscillator that it's a formula we use to indicate overbought and oversold. And as you can see, if you go back to 1999, we've been up to, actually we've never been this overbought. And whenever you get to these levels, normally is almost always followed by a fairly substantial decline in prices. So while not yet confirmed, this market looks very toppy. If you look at the soybean meal October market, that market closed today at 402.60. Below yesterday's lows. Speculatively, we shorted this market yesterday. I think it's worth taking an aggressive short position in right now. It's just stood on end. You know, sometimes it's hard to believe technical indicators. I mean, us and a lot of other people didn't believe the buy signals. If you go back into early April, it's pretty obvious when this market started breaking through its moving averages. That's an 18 and 40-day moving average on this chart. Took out the previous week's highs. I mean, the buy signals in meal just screamed at everybody, and everybody said, oh, we've got too many beans. Brazil's got too big of a crop. This can't happen. But you know what? Old rules in commodity trading have never changed. Markets bottom on negative news. This one bottomed on negative news, just like it peaked in 2012 on bullish news. And now everything is bullish on the soy complex. Everybody's concerned about what's going on in South America. Again, this is a supply-driven bull move, not a demand-driven bull move. Supply-driven bull moves peak quickly and then collapse. And so don't get confused on this one and assume this is demand-driven. It's not. Take a few make a few comments on dairy. I never feel as though it's my position to talk on dairy to dairy producers. Most of you forgot more about the dairy industry than I'll ever learn. So I just want to provide a couple insights on what's going on. As we see it, production obviously going through the roof. Very seasonal production. We're slightly above a year ago, but as we know what the seasonals are in that, same thing in cheese production. We take a look at total milk production, though, for major exporters. This has been pretty concerning up until 2 months ago. Major exporters production was up sharply. Now one of the things that's helped the price of milk is it's dropped back down to about where it was a year ago. Virtually all the production growth in the first quarter came from the EU, up 5.9% in the first quarter, Ireland up 31%, Netherlands up 17%, Germany up 5%, we were only up 1%. New Zealand was actually down, as was Australia. So we're seeing some very big changes around the world right now, and as a lot of it's caused by economic problems in some of these countries. We take a look at milk production versus exports of the top 5 suppliers. You know, exports of the top 5 suppliers have been relatively flat, but production up. We take a look at China's demand appetite, promising for 2016. Imports were up 32% in the first quarter, but New Zealand's exports to China were down significantly. We take a look at Japan's imports of milk, of powder, cheese, butterfat, and whey were down 3%. South Korea down 8%. Again, the demand side weakening has caused much of the bear market we saw in the first 6 months of this, or first 5 months of this year. This is taken from the U.S. Dairy Export Council. Cheese prices adjusting downward in the near term, obviously not helping most people in the dairy industry. And as we take a look, though, as our input prices, as all of you know, at least input prices have dropped, alfalfa specifically. You take a look at the USDA's forecast of Class 3 milk, $14 to $15 for 17, $13.40 to $13.80 for 16. Which brings us to the chart and the graphics. And clearly, the trend has been one directional for the last 9 months. But here's what's really interesting. I think milk trades extremely well technically. If you go back to the left side of this chart, you'll see in early November the market gapped lower and then dropped through the 40-day moving average and has basically been under it until recently. As this market was making new lows in May, when all the news was bearish, and those of you that have read my book and follow technical rules, you understand what a 5 wave is. This was the most classic 5 wave I've ever seen at the bottom of a market, and also had a key reversal up in May. This was a major buy signal in milk back in the 3rd week of May, and a clear sign of what was happening in this market from a technical point of view. Again, it was one that clearly had discounted the negative news. Now, this thing has shot up so sharply. I mean, today we got it to $16. Today, some of you would know this better than I, but I think this is the biggest trading range in milk in at least 5 years' time. I'm not sure we've ever seen anything like this. And last I saw, this is July milk. This chart was put together again a couple of hours ago, and I see July milk. I'm sure it was last at 15.01. And so it closed down slightly lower for the day. Spikes up like this are a selling opportunity, and also if you look back into early January, you'll see a gap that was left in this chart at 15.50. Yeah, I think in 3 weeks' time we'll look back and say, okay, if you had milk that needed to be priced, probably should have been doing 20–25% of it in this rally. I mean, this could turn out to be a real gift here in the long-term picture of milk prices. So, I hate to be a two-armed economist, but I think we shifted into a range here where the resistance is now going to be 16, and the support though is going to be at 13.55 down at the bottom end of these moving averages. And but as we go in these summer months, and as we know, as the heat comes in, milk production declines. So we should be inclined to be in the upper end of that market. Deese milk is pretty much the same thing. It finished about the same price where it was today, not much of a change. We've rallied back to where this rally started, where the downtrend started back at 1580. We might be able to get the Deese market up to that 1620 area, but I really doubt it. If I were a producer, I'd be scaling and selling some of my milk. Here are some comments here. Someone asked the question, David, want to show me that again? El Nino following La Nina, the other way around. We use two different weather services, and both of them are pretty much on the same page on this shift, and that is that it normally does not lead to significant drought conditions in the Midwest. Now, most people, when we're talking about drought conditions, it's the Midwest that's going to be impacted the most when it comes to corn and soybean production. And so, while they're saying it could be hotter, they're saying that we're going to have plenty of moisture to go with it. And so we feel, again, based upon the two different weather services that we're looking at, that the main part of a drought has been taken out of the picture for this summer. I think, if we were to have had this webinar 2 months ago, we'd probably had a totally different attitude. But I think we're now looking at markets where your protein and feed costs are peaking. If we're not haven't made the top, we're within 10% of it. Milk prices have discounted most of the negative news, but again, I think in any market, when you have the kind of rally that we just had in milk in the last week, you ought to be letting the market own some of this. And I think the other risk that we have to watch, that we've always had some of this, but the international turmoil right now, you take a look what's going on in Venezuela and other countries and what that's going to do to their buying power. This is not a real positive long-term trend. But we take a look at the positive long-term trend in feed values and that we're exporting our technology, then I don't think you're looking at the kind of bull markets we saw in 2012 for a long time. So that's pretty much all I have to say. For the first time in my life, and some of you appreciate that, I finished in less than the time allotted. That's a rarity. I'm 5 minutes early. And so if any of you have any other questions, again, if you, at this stage, I think if you just hit #95#, we can take them. And my assistant here says we've got some questions coming in, so just hang with me.
Do you think there will be a large change to GMO-free corn production?
Do I think there will be a large change to GMO-free corn production? No. It's going to take a long time to turn this thing around. And I think it's a slow growth market, and it's going to be there. But those of you in the GMO business know better than I, to go from non-GMO to GMO is an extremely expensive process. A friend of mine down in Destin, Florida, bought some land north of Destin. And I'm talking, as most of you know, in northern Florida, it's not the most productive farmland, but you can raise 60, 65 bushel beans. And he has 200 acres of non-GMO soybeans that he sold this past year for $18.50 a bushel. He's also selling GMO alfalfa. And for those of you, I assume some of you are on from the Florida area, is going down to Ocala, going into the horse barns, and so he's doing really well. But when you go out and buy a $400,000, $500,000 combine to harvest 200 acres of corn or 200 acres of soybeans, and you're looking at that outlay, because that combine cannot harvest GMO products, and so it's limited to the GMO seed. So I think the entry cost is going to really slow the advancement of GMO. I think we're going to continue to grow it, but it's going to be really, really slow. All right, another question is
the GMO-free situation being driven by EU CPG companies are at a disadvantage to U.S. versus...
All right, let me read the question again. It says, is the GMO-free situation being driven by EU CPG companies or are at a disadvantage? Are we at a disadvantage in the U.S. versus the millennial pushing for clean label foods. Yeah, we're probably at a slight disadvantage for that right now. I think we probably have been slower than we should have been to adapt to the millennial demands for these kind of products, and it's going to grow. But you know, the economics of this are going to determine that. At some point, as those of you know, in certain areas, there's been resistance to the prices of GMO meat, milk, certainly GMO eggs as well, and GMO beef. And yet, this millennial group wants it. Whole Foods just opened a store down in Destin, Florida, and you can't find a parking spot in the lot most days as the demand for those products increases rapidly. So, you know, I think obviously good margins there, and but once you get positioned, then you can start expanding in the GMO area. But right now, again, the cost of entry is high. All right, that's the last question I see up here. Is there anything else before we call it a day? All right, always a pleasure, and if you have any questions, you know where we are. Give us a call. Have a good day.